Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent. Ask yourself, are you looking to add some new dividend stocks to your portfolio? Well, you've came to the right place. Today we're going to be covering 5 of the best dividend stocks going ex-dividend next week, November 5th through the 9th, 2018. Now, if you watched my video on Monday, we went through the process of how I collect the dividend stocks in order to do these. We head over to dividend.com, we go by ex-dividend, we sort by the following week. We picked up roughly 50 stocks to screen, we put them in the Y charts, and we screen them for rising revenue, or initially we knocked them off. Any stocks that had a yield starting at 1.5 or below, they were automatically removed from the list. Then we took a look at their 10-year and 5-year to make sure that they were rising in revenue, rising in net income, and rising in free cash flow over the last 5 and 10 years. So all of these stocks passed the list. We had about 13 stocks that actually made it through. We then looked at PE ratios going forward in 2019, that the PE ratio was expected to drop. Some of them were actually going to drop by a substantial amount, and that their earnings per share were expected to grow in 2019 as well. So sometimes the earnings can grow, but their actual PE ratio gets larger or higher, because even though they're taking in more income, sometimes some other areas they've taken in more debt, it becomes uncontrollable, and their PE ratio does climb that way. And all of these stocks here, these 5 stocks, have grown their dividend for at least 5 years or longer. So here we have 5 stocks here to discuss today. Ticker symbol BSET. This is Beset Furniture Industries. They're in the services sector. We have ticker symbol COLB. This is Columbia Banking System. They're in the financial sector. We have ticker symbol HFWA. This is the Heritage Financial Corp. They're also in the financial sector. We have ticker symbol MSM. This is Msc Industrial Direct. This is in the consumer goods sector. And last year, we have ticker symbol WBS. This is the Webster Financial Corp. So we have 3 financials, a services, and a consumer goods. Now, initially, we had about 13 stocks there. Some of them were technology. Intel actually made it on as far as through our screening process, but Intel had only grown their dividends for roughly, it was 3 or 4 years, and our cutoff was 5 years. So we took the stocks that have grown their dividend for at least 5 years, and these are the ones that were in that list. If you go back and watch Monday's video, we go over the whole process of how we found the stocks, put them into the list, the screening process, and we actually had about 13 stocks that were actually fairly good looking stocks, but these are the ones that ultimately made it onto the list. Now, if you haven't got started in your investment journey, you guys can check out M1 Finance or Robinhood. I prefer M1 Finance for brand new investors because you're able to start your Roth IRA, which is just it's a tax sheltered account where you can grow all your capital gains, your dividends, all the interest in that account if you're buying bonds, 100% tax free. And at 59.5, you don't have to worry about paying any taxes because you paid them up front and going into the account with after-tax money. Great account there. So all of these stocks are ordered by ex-dividends going November 5th through the 9th. So they may have a 1 next to them, but that doesn't mean that they're number 1. That is just the rank that they're going in, ex-dividend next week. So number 1, we have ticker symbol WBS. This is Webster Financial. It's a holding company for the Webster Bank National Association. It has over $17.2 billion in assets. Webster provides business and consumer banking, mortgage insurance, financial planning, trust, and investment services. So this stock is going ex-dividend on the 5th of November, which is Monday. You would have to buy this stock this Friday or prior in order to be eligible for that payout on the 20th of November. Now here, I like to display their 10-year chart here. This is showing in the green their net income over 1,000% over the last 10 years. So here, this is the 10-year graph. So any of these numbers here, you divide it by 10, and that'll get your average year-over-year increase. So here, 1,000 by 10, that's 100%. So their income goes up roughly 100% year-over-year for the past 10 years. Their price here, 227 by 10, that's 22.7% increase in their price alone over the past 10 years. This does not include dividend. Their dividend yield, you can see here, sits around at 2%. So they actually push out 24% per year in in price appreciation, but they pay out to their shareholders 2%. So they end up rising in price by 22% and then paying to their shareholders 2% of that. And then here in the red, they have free cash flow up 6.5% year over year. And in the orange, revenue up 5.67% year over the last 10 years. So great looking company here, financial here. Now taking a look here at their 1 year. So here up at the top, we have their 1 year chart. We can see that they pay out 33 cents per share each quarter to their shareholders. Here in this sort of dark brown or like a brownish color, this is their 200-day simple moving average. So their currently 200-day simple moving average is $61.35. Their current price is actually below their 200-day moving average. As you know, here in October, lots of stocks across the broadband of it all they've been all slammed here. So a lot of these stocks have broken below their 52-week or their 200-day simple moving averages, their 200-day moving averages. So here, this one broke. It's at $58.55 at the time of this recording. And its yield is actually up to 2.25. They recently increased their dividend here. Back in January, they hiked it up from roughly 26 cents to now 33 cents per share. So that dividend yield sits around 2.25, 2.2, depending on the day. Their current PE is at a 16.72. Forward PE is at a 15.7. Price to sales is at a 4.69, and price to book is at a 2.02. So when charted, it does show the current stock does have a price underneath the yield currently, which may indicate it could be at an undervalued state at this time. The stock is also trading above the industry average. The industry average for financials is 13.8. It's actually at a 16.72, so it is slightly over that industry average there. But it is sitting below the S&P 500 average of 21.56. So if you were to compare it mainly to the industry, it is slightly over in the industry here. It is sitting below 60% payout ratio. It has a payout ratio of 36.2, and it's grown its dividend for the past 7 years. So back since 2011, it started raising its dividend year over year. This company did cut their dividend going into the recession here. They did cut it back. I don't think they had cut it out completely, but they did cut it back by quite a bit. So this is an asset-based company. So with assets, anything, this is more of a financial. So financial asset-based companies that have a lot of assets on the books are a little bit different than this ratio here. If you're looking at financials, normally you would rate them right around a 1.5, 1.4 to 1.7 price to book value. So this company probably can come down a little bit further. I would expect this one to maybe fall down into that $50, $55 range at some point, and that would be more of a deal there. But if you like the stock, check it out. Here, their current PE, we already covered it. Industry S&P 500 currently sitting at a 21.56. This is on Monday, and I believe Monday when I did this, the markets had actually came down in the after hours. Towards the end of the day, it was a sell-off. So dividend yield 2.25. They pay out $1.32 per share each year. Their current payout ratio 36.2. 7 years of dividend growth. They've grown their dividend over the last 5 and 10 years, an average of 12%. But they did have that cut back between 2007 2010, and they just started raising it again in 2011. So that is ticker symbol WBS. Number 2, we have ticker symbol COLB. This is the Columbia Banking System. It is headquartered over in Tacoma, Washington. Columbia Banking System is a holding company and has 155 banking offices across Washington, Idaho, and Oregon. So their ex-dividend is on Tuesday, the 6th of November. If you were to buy the stock for the ex-dividend, you'd have to buy it on Monday or prior, and then you'll get paid out on the 21st of November. Here, again, we have the price, revenue, free cash flow, net income. In the green here is their net income up 2,000% there. So they raised their net income by an average of 200% per year over the last 10 years. You can see they took a slight dip here in 2008 to 2010, but their price did not dip there. You can see that their price remained fairly flat through that recessional period. I don't know if that's a word, but here, over the main part here in the red, we have their free cash flow up 26% over the past 10 years per year. In the orange, we have their revenue up 25.8% year over year, and the price is up 16.5%, which is really good for a financial. A lot of these financials, JP Morgan, Goldman Sachs, Citigroup, they've been hammered recently, and they don't have a lot of growth as far as their price goes. It's been remaining pretty flat. I believe JP Morgan is actually up pretty well. I'd have to check that one out, but just, this one's up 16.5% year over year just in its price. It also pays out a nice 2.7% yield, which is not quite the highest. If you would have locked in a little bit earlier during the complete downturn, just not too long ago, you would have locked in a little bit over at 2.75. Oh, okay, so it looks like they did raise their dividend. You can see this huge dividend spike. So just like all other financials, the screen was sort of pulled back on them. You saw, if you read on the news, JP Morgan increased their dividend by some 46%. So financials, they kind of got the roles pulled off of them, and a lot of these financial companies, you can see this one raised their dividend from roughly 26 cents per share to now 40 cents per share. So this one, another 50% rate hike there in dividends. So a very huge increase there. So this one currently pays out 40 cents per share each quarter. Its 200-day moving average is $41.92. It's currently priced at $36.88. You can see that this is actually the lowest point in 2017 or 2018, going backwards here. Its dividend yield is currently at a 2.82 due to this new dividend increase. You can see that they raised it here from, it was around that 2%, but now they're now at a 2.82 with that new dividend hike. Their current PE ratio is at a 19.02. Their forward PE is at a 14.77. Their price to sales is at a 4.7. And here, remember, we were talking about financials. Financials should be in that 1.3, 1.7 range. This one is sitting at a 1.36 as far as price to book value. So when charted, it does show the current stock does have a price underneath the yield, which may indicate it could be undervalued at this time. The stock is also trading above the industry average of 13.8, below the S&P 500 average of 21.56. It is sitting below 60% payout ratio. It has a payout ratio of 41.6. It's grown its dividend for the past 7 years since 2011. Its price to book is at a 1.36, which is below that 3.0 baseline where asset-based companies would be considered a deal. This is the financial, so this is more in that 1.3, 1.7 range. Price to sales is at a 4.75, which is slightly higher for those sales and services-based companies. So here, dividend yield currently right around a 2.82. They pay out $1.04 per share each year. Very low payout ratio. Basically, they could lose half their earnings, still be around a 75-80% payout ratio. Grown their dividend for the past 7 years. Their average increase lately for the past 5 and 10 years has been 59%, or around 50%. That is just because they cut their dividend back in the financial times. I don't believe they locked it out. I believe they'd actually cut it back down by quite a bit, and then they started raising it very fast after 2011 to kind of get back to where they were. And you can see here these huge hikes here. That's just a very nice increase. Their increase for the last 10 years is right around 50%. So very nice upticks. Number 3, we have ticker symbol HFWA. This is the Heritage Financial Corporation, another financial. It's a banking holding company. The company is engaged in the business of planning, directing, and coordinating the business activities of its bank subsidiaries. Heritage Bank, the bank, also does activities focused on commercial business lending. The bank also originates consumer loans, real estate construction, land development loans, and 1 to 4 residential loans. So those FHA loans, anywhere between single-family homes to multifamily homes, less than 4 residential areas. So ex-dividend, again, next Tuesday, the 6th of November. You'd have to buy this one on Monday or prior. If you were to lock in and hold it until Tuesday, you would get paid out on the 21st of November. You would get paid out 27 cents per share for each share that you recently bought. You can see they did dip here. This one has special payouts, I believe. Oh, both of these two companies here, we can actually pull these up. We'll complete this and then we'll go back and take a look. But both of these two companies here, I know 2 financials here are paying a special dividend as well. So I wanted to put that out in the video as well. Let's quickly go over the rest of these real quick and we'll jump back at that. So here, net income up 63% year over year over the last 10 years. And it's up 631%, but if you go back, divide it by 10, that's 63.17% year over year increase there in their net income. They're in the orange here, revenue up 33.4% year over year. In the red, free cash flow at 20.7, and their price is up 16.1% on average for the past 10 years. Here is their 1-year dividend. They currently pay out 27 cents per share. This looks like they actually cut their dividend, but what they do is they pay out pretty often special payouts. So this was a special payout back here of around 40 some cents, I believe, 30 some, 40 some cents. They do these special payouts quite often. Currently they're paying out 27 cents per share each quarter. Their current 200-day moving average is $33.08. They're currently priced right around $32.26. That gives them a yield of around 2.11 to 1.8, somewhere within that range, depends on the price of the stock. You can see that they actually raised their dividend going into this quarter. So this is the brand new dividend they're going to be paying out at this price. You can see they went from roughly 16 cents per share to now 27 cents per share. So this is actually their new yield at 2.11, which puts them up here off the charts. Their PE ratio is at a 23.49. Their forward PE is at a 19.13. Price of sales is at a 5.2. And price to book is at a 1.59. So again, if we're taking a look at financials, anywhere between 1.3 to 1.7. This one sits right around that 1.5, 1.6 area. So when charted, it just showed the current stock price is below the yield, which may indicate it could be undervalued at this time. The stock is trading above the industry average of 13.8 for the financials and above the S&P 500 average of 21.56. It is sitting below 60% payout ratio at 38% payout. Dividend growth again for the past 7 years. Price to book 1.59, which is below those asset-based company areas, or 1.5 range for those financials. Price to sales 5.26, which is above that 3.0 range for sales and service-based companies. And we've already kind of covered this. Quick recap there. So they raised their dividend roughly 9% on average over the last 10 years since 2011. So that was ticker symbol HFWA. Next, we have number 4, ticker symbol BSET. This is Beset Furniture Industries. They're in the services sector. They're incorporated, or they have a manufacturer. They do importing, retail, and home furnishing. The company's segments include wholesale, retail, company-owned stores, and logistical services. Its wholesale home furnishing segments is involved in design, manufacture, sourcing, sale, and distribution of furniture products through the network of Beset stores. So it does a lot of independent furniture retailers as well. Ex-dividend is next Thursday, the 8th of November. If you'd have to buy it on Wednesday or prior, hold it until Thursday, and then you'll get paid out on the 23rd of November. Here we can see their 10-year chart. In the red here, we have their free cash flow up 19.2% on average per year. You can see that they did dive into their free cash flow between that 2012-2014 area, but they quickly recovered and has been on the up. Their price here in the blue up 13.4% on average. It has came down. You can see that it has peaked a couple times right around this point here in 2015 midpoint, and then again recently in 2017 they peaked again. So this one doesn't trend upwards in a steady motion. You can see here that it's really been kind of trending sideways. It really hasn't gone anywhere. As of 2015, this stock's really gone nowhere but sideways, and it's actually, if you had bought it anywhere above January, February of 2015, you'd probably be in the negative right now if you had held it for the long term. Here in the orange, revenue up 8.2% per year. So this company could be pulling back here with revenue. You can see it's been sort of flat here recently. In the green, net income up 32.94 over the last 10 years. So that's an average increase there of net income of 3.2. So here we have their 1 year graph. They currently pay out 12 cents and a half a cent there per share each quarter. Their 200-day moving average is 27.51. You can see that they've came down hard. This company used to be priced somewhere within that $40, $50 range, and they've dropped all the way down to $19.57. They have a current dividend yield of around 2.55 because of this recent dividend increase. You can see it's very slightly here. After May, they announced a dividend increase and they went up from roughly 8 cents per share, maybe 9 cents per share, to now 12 cents per share. Their PE ratio is at an 18.33. Forward PE is at a 16.18. Price to book is at a 1.06. So very flat as far as price to book value of however many assets it has on its book value. And in comparison to its price to sales is at a 0.45. So this could be an undervalued stock, but it really depends. We can see that its net income hasn't been, it's actually on a downhill as of 2016. Kind of goes along with their price. If you follow their price and you look at their net income, when they went to their investors, looks like 2013 was like their highest point here as far as net income goes. And they just, they had it dip. And that price kind of followed along with their earnings here, their net income dragging down. They began to show a rise of net income between 2015 and 16, and then here they probably announced during a quarter that they're going to be lowering their earnings going forward, and this company started to report lower, and their net income dropped and their price dropped, and you can kind of just follow along how the news kind of plays out there. So low payout ratio, it's at a payout ratio, let's go ahead and move this bar down, 42% payout ratio, dividend growth for the past 5 years, price to book 1.06, price to sales is at a 0.45. So very low stats. Price to book, very rarely you find a company out there with a price to book of around, a flat 1. You're basically buying it for a price value to its assets, and you very rarely find a price to sales ratio below 1 here. So very low ratios. If you take a look at this company and find out anything more about it, let me know in the comment section below. I think it'd be kind of interesting. I probably won't look into. I don't really like furniture companies. Not too many of them out there that I would invest in. So price to the PE ratio, price to earnings 18.33, industry average 17.3, S&P 500 21.56. They pay out 50 cents per share each year, or 12 cents and a half cent there each quarter per share. They've grown their dividend for the past 5 years since 2013 at an average increase there of 12.05. This is a little bit of a risky play. Depends how, if you look at their financial statements, you take a look at their earnings, and they're going somewhere. They're making some new line of product that consumers are going to really want. It could be a good buying opportunity. Anyways. Number 5, we have ticker symbol MSM. This is the Msc Industrial Direct. It is a North American distributor of metalworking and maintenance, repair, and operation MRO products and services. The company's range of MRO products include cutting tools, measuring equipment, tools, components, metalworking products, fasteners, flat stock, raw materials, abrasives, machinery, hand and power tools, safety and janitorial supplies, plumbing supplies, material handling products, and so on. Their ex-dividend is next Friday, the 9th of November. You'd have to buy the stock on Thursday or prior to be eligible for that payout on the 27th of November. Here in the blue, price up 11.9% on average per year. Has been trading sideways here as of 2012, gone nowhere else but sideways. Here in the orange, revenue up 7.5% over the last 10 years. And the green, net income up 6.2% over the last 10 years. And in the red, free cash flow up 1.9% on average over the last 10 years. If we look at their 1-year graph here, they pay out 63 cents per share each quarter. Their 200-day moving average is $88.37. They've dropped now to its lowest point here, $76.53 for the year. That puts them at a dividend yield, because they just raised their dividend here from 57 cents per share to now 63 cents per share. That puts them at a dividend yield of 3.29, which is actually way up here off the charts. Current PE is at a 13.74. Forward PE is at a 12.95. Price to book 3.0, and price to sales 1.39. So when charted, it does show the current stock does have a price underneath the yield, which may indicate it could be undervalued at this time. The stock is below the industry average of 16.8 and also below the S&P 500 average of 21.56. It is sitting below the 60% payout ratio at 49.7. Dividend growth for the past 7 years at a rate of 19.75. It's price to book right around that 3.0 range, which is at that 3.0 range where asset-based companies would be considered a deal. This is a ticker symbol MSM. Okay, that was in the consumer goods. So I would say that this is a service and sales based company, and a price of sales at 1.39. I would say that's a pretty good deal. Let's see here, 7 years dividend growth at an average increase there of 19.75. This is sort of one of those consumer cynical. It's consumer goods, but it's very specific niche there. Not a lot, if you go out and buy Johnson & Johnson in comparison, people are going to buy those products. They're healthcare products and such. They're needed for the home and such. So that is the article there. So again, the 5 stocks this week, if we just head over to the top, we'll go down each one. Number 1, WBS. This is the financial sector, the Webster Financial Corp. Number 2, we have ticker symbol COLB, the Columbia Banking System. Number 3, we have HFWA, the Heritage Financial Corp. Number 4, BSET, the Beset Furniture Industries. And number 5, we have MSM, the Msc Industrial Direct. Now, out of these 5 stocks, the ones that sort of looked very interesting to me were these Heritage, the Heritage Financial, and the Columbia Banking System. Now, those are ones, I wanted to go ahead and pull those up here in my dividend.com here. So we can go ahead and check out HFWA. And I believe these are the 2 that were, they also had special payouts. And BSET. Okay. So here, if we move down, okay, yes. So here, special payout. They're going to be paying out 10 cents per share going ex-dividend on the 6th. So at the same time that they're doing their regular dividend, they're going to be doing a special dividend as well. So you're going to get 27 cents per share there from their special payout and their regular payout. So if you have this inside a Roth IRA, you're going to get basically a double whammy there. You're going to get 2 sets of dividend and regular. You can see that this happens fairly often. If we take a look at their chart, we can see that they've been paying out special payouts, 25 cents per share, 30 cents per share. So they've been raising their dividend of since 2011, but they also have these special payouts on top. So it looks like they did cut their dividend there. If we zoom into this area right there between 2009 and 2011, they just straight cut their dividend. So that's one of the things. If you're a DGI, like a dividend growth investor, dividend growth investor, this may be one of your stocks that you just not even considered, because there may be a time during a downturn where this company would just completely cut their dividend. And you can see that they've kind of paid back their shareholders that have been long-term shareholders. They've, while they may have cut their dividend, they really tried to pay back to those shareholders that really hold their stock by paying out those special dividends to them. Now, this other one here, BSET. Oh, this may not have been it. I don't think this one has it. Looks like they did have some sort of a special payout here. But they also cut their dividend here between 2008 and 2011. So I believe the other company I had been thinking about was BSET. That was the, oh, no, that's the one I just, COLB. Whoops, COLB. Columbia Banking System. I believe this is the other one that had that special payout. Yep, okay, so this is the other one that had special payout. This one's doing a special payout right along with its own dividend, 14 cents per share on top of 26 cents per share. So that's 42 cents per share that you're going to get for the stock, and it's priced at $37.52, savings and loans. If we take a look here at their dividend history, we can see that, during the downturn, they did cut their dividend between 2008, they cut their dividend here from 17 to 7 to 4 to 1, and then just kept their dividend locked out at 1 cent per share. And then once they recovered, they had cash on their the balance sheets, they could pay out to their shareholders. They started raising it 3, 5, 6, 5 with special payouts. So they were kind of paying back to their shareholders that didn't really sell off their stock. They had the money on hand, but they probably put in some regulations. I think the big deal, the main reason a lot of these financials had to cut their dividend, if you go back, they may have had the cash available to pay out to their shareholders, but regulations may have been put in place to say, hey, everybody stop paying out a dividend just completely cut it, and they had to do that. So here, they either had to cut it to a very low amount, or they just had to completely knock it out. And some of these companies that have a lot of free cash flow, a lot of books on the money on the books, they've tried to help their pay out to their shareholders. So I thought those were some interesting ones to check out this week. So ticker symbol COLB and ticker symbol HFWA. I think those are pretty interesting financials. So that is it for today's video. If you guys did like it, give it a thumbs up button below. As a quick disclaimer, I'm not a financial advisor, tax professional of any sorts. The information provided is my opinion for entertainment and fun. This is just me as a financial investor trying to help others make the money work for them. If you guys ever have any questions at all about anything that's ever covered, just let me know in the comment section below or write me over on Facebook. People chat with me all the time on Facebook. I'm always on there. So that is it for this video. Thank you guys for tuning in. If you are brand new to the channel, I do make stock market, personal finance, and real estate investment videos every single week, so consider subscribing, and I will see you next time. Have a good day. Bye.